The following video is an extract from the Udemy course, Learn to Construct Financial Statements from the Ground Up. If you would like to purchase the full course, you can do so by using the link below. Hello and welcome back to this next lesson where we will be covering in more depth the primary statements. As a recap, the three primary statements are the balance sheet, the income statement and the cash flow statement. Beginning with the balance sheet. As we spoke about, the balance sheet shows a company's assets, liabilities and equity at a point in time. In terms of owner's equity, we spoke about various types of businesses in a previous lesson, and one type of business is an incorporated entity or a limited company. The owners of a limited company are referred to as shareholders, so that's just something to be aware of. Moving on then to define those three items. An asset can be defined as a resource with economic value with the expectation it will provide future benefits. So for example, cash is an asset, or another asset might be if a business owned property, as the property would provide future benefits to that business. In terms then of a liability can be defined as an obligation to pay a person or entity as a result of a past transaction or event. A bank loan, for example, is a liability as there is an obligation to pay that loan back to the banking institution. Owner's equity then is what the owner is owed by the business after you've subtracted all the liabilities and debts owed against the assets of a business. Owner's equity is effectively the assets of a company minus the liabilities. A point to note is that, broadly speaking, any transactions between the owners of the business and the business itself impacts on equity. So for example, if a business pays shareholders a dividend, this would impact equity. In our first interactive workbook 1, you'll see the impact of when an owner injects funds into a business and how this impacts upon equity. The fact that equity is equal to assets less liabilities is driven by the accounting equation. The accounting equation follows the underlying principle that assets are equal to liabilities plus equity. We will be applying transactions to demonstrate the impact on the accounting equation in our next tutorial. Moving now back to our balance sheet and assets and liabilities. Assets and liabilities can both be broken down further into current assets and current liabilities, and non-current assets and non-current liabilities. In terms of what a current asset is, it is an asset that will be used in a period of less than 1 year, whereas a current liability, is a liability that will be settled in a period of less than 1 year from the accounting period end, so from that balance sheet date. So in terms of then a non-current asset, it is an asset that will be used or consumed by a business in a period of greater than 1 year. And then in terms of a non-current liability, it is a liability that will be settled in a period greater than 1 year at the period end date. In terms of some examples of current assets, current liabilities, non-current assets and non-current liabilities, we'll just go through a few of them here in this slide. So in terms of current assets, cash is a current asset, trade debtors and inventory would be examples of current assets. There are assets where there will be an economic benefit derived in a period of less than 1 year. In terms of current liabilities, these are liabilities that will be settled in a period of less than 1 year. So a bank loan, the element that is due in less than 12 months or 1 year is considered to be current. Trade creditors, so they're effectively purchases made on credit. There's going to be an outflow to settle a past transaction or event, so that is an example of a current liability. And they spoke previously about the accruals concept. An expense accrual will typically be paid in a period of less than 12 months. That will be deemed a current liability. In terms of non-current assets then, some are illustrated here. So property, plant and equipment, land and buildings and motor vehicles are all assets that will be used by a business in a period of greater than 1 year, so they are deemed to be non-current. And then finally, in terms of non-current liabilities, bank loans for a period of greater than 12 months or any other debt repayable beyond 12 months is deemed non-current. In terms of how that translates then into a balance sheet, so this is a typical illustrative balance sheet, and this time we've got some numbers attributed to it. So just in terms of where you'd expect to see some of these items, a non-current asset might be located in this section of a balance sheet. Current asset somewhere here. In terms of our current and non-current liabilities, they might be split in something like this. And then finally we've got our equity. And we spoke about the accounting equation. So with the figures in this balance sheet, we can now illustrate the accounting equation just to give you an appreciation of how the accounting equation is reflected in a balance sheet. So we've got our total non-current and current assets located here in the red boxes, so they both sum to 118,752. Our non-current and current liabilities are located here, so when you add them two together, you get 62,973, and then the total of our equity is 55,779. So we can see total assets are equal to our liabilities plus equity. So if you sum up our liabilities plus our equity, that'll give us a sum of our total assets. Our next primary statement is the income statement. The income statement, which is often referred to as a profit and loss account, shows revenues and expenses over a company's reporting period. So that could be 1 month, a year, or 6 months. The income statement sets out the users of the financial statements whether a company is generating a profit or a loss. So we've got an example of an income statement here. We have got XYZ Limited's income statement for the period ending. The year ending in this case is 12 months, so 31 December 2004. Some turnover here, or revenue, less various expenses to arrive at a profit then. So that's just an example of an income statement. You will recall that the income statement and the balance sheet are prepared on an accruals basis of accounting. The income statement is effectively a linking statement between our opening balance sheet and our closing balance sheet. So we will see an example of that in our next tutorial as well, just to be aware of that now, that the income statement and balance sheet are both prepared on an accruals basis of accounting, whereas the cash flow statement is prepared on a cash basis of accounting.